this video, we'll talk about how to get a mortgage pre-approval. What's the difference between pre-qualification versus pre-approval, the documents you need to provide to the lender, should you work with your bank or mortgage broker, and lastly, the different types of mortgages like the variable rate mortgages and the fixed rate mortgages. Hey everyone, this is Fawad Nasari from eXp Realty Nasari Brothers, and welcome to the second part series on how to buy your first property here in Canada in 2022. If this is your first time on this channel and looking to get some insight into the Canadian real estate market, well, you're in the right place. We create weekly educational content related to Canadian real estate, market updates, interest rate changes, and everything about buying and selling real estate. If you're into this kind of content, consider subscribing, hit the notification bell so you're notified as soon as we upload our next video. And now let's talk about the mortgage pre-approval process. Well, there's this big confusion around mortgage pre-qualification and pre-approval. There are a lot of websites online offering get pre-approval in under 5 minutes, start your approval in minutes, etc. But the reality is, unless you provide all your documents, it's not a real mortgage pre-approval. To get a pre-approval, your mortgage broker or bank will ask you for a bunch of documents. For example, your employment letter, your pay stub, your T4s and notice of assessment, 90-day bank statement, proof of down payment, and then pulls your credit and go through a complete application process. And that is a valid pre-approval. Now, how long does a mortgage pre-approval take? Well, it typically takes a few days, although it could take longer in some cases. It also depends on how fast you can supply all the documentation they need from you to verify your information. Now, how long is a mortgage pre-approval good for? Well, your mortgage pre-approval depends on the lender. Typically, you will be approved for a period of 90 to 120 days, giving you enough time to look for a home. Some lenders will allow you an extension for your mortgage pre-approval. This pre-approval also comes with a rate hold. Let's say you're pre-approved by one of the major banks with a 3.5% fixed rate. This 3.5% fixed rate that you're approved for is a guaranteed rate for the next 90 to 120 days. So even if the interest rate goes up, your rate hold will stay at 3.5%. This does not apply to variable rate mortgages because variable rate fluctuates based on the Bank of Canada's overnight rate. Please do keep in mind, if your financial situation changes after getting your pre-approval, like changing jobs, buying a car, or taking on a new loan, your mortgage pre-approval could very well be revoked. So try to hold off on making those changes until you close on your property. And what's the difference between variable mortgage and a fixed mortgage? Well, to put it in the simplest term, a fixed mortgage locks your rate for a period of time, say 5 years. It doesn't matter if the rate goes up or down, your monthly payment will not change for that period of time, whether it's 3 years, 5 years, and so on. Fixed rates are typically higher than variable rate, but provide a consistent mortgage payment for years to come. Now, if you break your fixed rate mortgage, there's often a bigger penalty. So you got a 5-year fixed mortgage on your house, and now your plans have changed and you want to sell your house. Well, if you break your mortgage, you'll pay a very, very high penalty, somewhere between $25,000, $30,000 to $40,000, depending on the mortgage amount. The reason for that is because fixed rate penalties are calculated based on the interest rate differential, meaning paying back the interest rate or the interest owed until the maturity of the term, which could lead to tens of thousands of dollars. It's also not possible to switch fixed rate into a variable rate without breaking your mortgage. Now, with variable rate, however, your rate changes over time with the Bank of Canada's overnight rate. Well, how does this work? Well, 8 times a year, the Bank of Canada gets together and determines whether or not to adjust the overnight rate. And since the start of the pandemic, the overnight rate had gone down by 1.5%, but now it's on the rise. It's expected the overnight rate to go up to possibly 2 to 2.5% to control inflation by 2023. Now, one thing to note, within the variable rate, there are 2 different products the banks usually offer. A variable rate mortgage is one where the interest rate changes with the overnight rate, but your monthly payments are always the same. For example, let's say your payment is $2,000 with $1,200 allocated towards your principal and $800 towards your interest. Now, because of the rate change, your principal may drop to $1,100 and interest may jump to $900, but your monthly payment will not change. Just the ratios of your principal and interest do. In the long run, banks make more money this way because you pay more interest. This is almost like a fixed rate, but without paying those high penalties if you were to break your mortgage. Now, an adjustable variable rate mortgage is one where the monthly payment can change when the Bank of Canada's overnight rate increases. So if your payment was $2,000, now it would be $2,100 or $2,200 due to the rate increase. Most of the traditional banks like BMO, CIBC, and TD offer the traditional variable rate and not adjustable variable rate. Now, if you break your variable rate mortgage, the penalty is typically a lot lower than fixed rate. Variable penalties are calculated based on a 3-month interest. For example, on an $800,000 property, the penalty to break your variable rate would be around $3,000. But if you have a fixed rate, the penalty to break would be $20,000 to $30,000. So that's essentially the difference between fixed and variable rate. Now, who can give a better rate, your bank or a mortgage broker? Well, if you go to your bank will only provide the product they have within their organization, while the mortgage broker can present multiple mortgage options. Mortgage brokers essentially negotiate the lowest rate for you, and because they have high volume of business with different banks and lenders, they can get you a discount and better product. At the end of the day, the rate is not the only factor when choosing a mortgage. It's really important to look at the terms, conditions, prepayment options, and penalties, so you don't end up paying a lot more in the long run. So working with a mortgage broker ensures that there's somebody who is going to make sure you get the right product and there are no surprises on your closing day. We work with a couple of mortgage brokers who are amazing. They get our clients pre-approved within a couple of days, and now we're ready to see properties. Comment below if you would like me to connect with one of our mortgage brokers. Okay, so now that you got an understanding a little bit about pre-approval and know exactly what you can afford, it's time to pick your team to help you with your home search. And on our next video, we're going to talk about how to pick your team and some of the tips and tricks to not end up with the wrong agent, to help you with your biggest purchase of your lifetime, possibly. To ensure you don't miss on the third video on this series, like and share, consider subscribing, hit the notification bell so you're notified as soon as we upload our next video, and we'll see you on the next one.